Welcome to our today's episode. Today we'll be doing revision concerning everything we have been teaching since last week. Alright, we'll be doing revision, and in this revision, this will be an interactive session. Okay, it will be an interactive session. I will ask questions, and if you fail my questions, you will have to pay for it. Okay, so listen attentively. Whenever you have any question, please make sure you write down the question in the comment section. All right, I will always review the comment section and I'll answer all your questions one after the other. All right, so let's proceed today. Now we want to talk about what? Market structure. I told you guys about market structure. It is a very important topic when it comes to what? Trading. You must know market structure. Some persons say market structure is the king. All right, if you don't know market structure, then I don't know what else you'll be doing in the industry. All right, market structure is simply the movement of the market. All right, how the market move from north to south, how the market move from east to west. I told you guys the market does not move in a straight line. All right, if the market wants to go to the north, for example, and here the market is at south, wants to go to the north, it doesn't go in a straight line like this. It does what? It moves in zigzag formation like this, something like this. All right, and that is exactly what creates the chart. Okay, that is exactly what creates the chart. So you have to listen attentively and understand when the market is going to the north or when the market is going to the south. So don't be carried away by this kind of movement. Some persons call it Elliott wave. There are a lot of terminology, a lot of vocabularies in this industry, but what is important is your understanding. Okay, you should understand when the market is going to the north and when the market is going to the south. All right, do not be carried away by this zigzag movement. I told you market does not go in a straight line. It might be going to the north. Okay, let me show you something. It might be going to the north, yet it will be going like this: up, down, up, down, up, down. You see it? Something like, sometimes it can be scattered. It can be going, it can be ranging at a point. It breaks structure, it range again. You know, it's just moving in a zigzag direction. There is no space. There is no straight movement to it. Okay, it's just bending up and down. Go here, go here, go here. But at the end of the day, we will get to what? The north. So what matters is, how do you know that the market is going to the north? That is why time frame is very important. We also review that time frame is very important. I did that. I discussed about time frame in the previous class, just the previous class. Time frame is very important. So you know that we have something we call higher time frame and lower time frame. The higher time frame, you know, makes decision. All right, the lower time frame only follows the decision of the higher time frame. So you have to be very careful and understand this movement. The higher time frame and the lower time frame. The higher time frame is like the mother time frame, and then the lower time frame is what? The child. So the child follow what? The decision of the mother. So you have to pay attention what? In the higher time frame. That is why it is in the higher time frame we want to get our bias. We want to get the direction of the market. All right, so that is that, but I'm coming to that. Let's just proceed. So market structure is simply what? The king, and it's just what? How markets move in a zigzag direction. The market direction, where market is going to, where it's heading to, where it is coming from. That is all about what? Market what? Structure. All right, so we have what? The bullish market breaking structure to the upside, breaking structure to the upside. You see it? This is bullish market. All right, we have bearish market, the opposite of the bullish market, breaking structure to the downside. This is market breaking structure to the downside. This is the arrow showing that what? It is bearish. And then we have what? The ranging market. The ranging market. In this ranging market, there is no what? Direction. It's just a kind of a parallel market. All right, some persons say it is sideways. It is not, there is no clear direction whether the market is going up or is coming down. It's just going up and down, up and down, up and down. There is no, and it's, at the end of the day, it is ranging in a box. All right, it is just ranging. So this is the three types of what? Market structure. We smart money traders, when it comes to ranging market, we stay away from the market because the market does not have a specific direction. So we don't want to make decision and say that we want to buy when the market is actually deciding. All right, when the big boys are negotiating, they have not finalized whether they are to buy or they are to sell, and you, just a retail trader, seeing that the big boys are yet to decide and you say you want to buy, okay, you can go in, but remember what? Your risk management. Okay, remember what? Your risk management. That will be our next class, risk management. I will teach you how to manage trade and how to manage your capital. All right, it is very, very important. So you don't trade in a ranging market. We don't do that. We just look at what bullish market and what bearish market. So that is that about what market structure. So let us look at demand and supply zone. I told you guys, demand and supply zone is just an area where we are interested in either buying the market or either selling the market. All right, you have Bitcoin, or let's say you want to buy Bitcoin. You cannot just go and buy Bitcoin anywhere. No, you have to buy at a demand zone. All right, you buy at a demand zone. Demand zone, it is the area where the price is cheap. All right, where the price is cheap. Let's look at this diagram, something like this. Now, price break structure to the upside. This is demand level. At this area, price is 1 naira. At this area, price is 100 naira. So you want price to come down to what, 1 naira, so that you buy, so you proceed. And then when you buy at 1 naira, once price get to this point, maybe about 50 naira, you're making profit. Once price get to this 100 naira level, you've made profit. All right, so you want to buy at what? A demand level. This is a demand level where people are what? Trying to buy. And remember, once you buy, your stop loss becomes under your demand level. So this place becomes what? Liquidity pool. All right, liquidity pool. And smart money are aware of that. So they know that a lot of money are resting below what? Demand zone and supply zone. So they will see how to manipulate traders just to what? Exchange their buy order or sell order. It cannot be overemphasized. You see, manipulation in the market cannot, in fact, it is part of trading industry. Now look at, for example, the banks. All right, the banks, JP Morgan, Chase, some smart money like the Ways, hedge funds. These people that has a lot of money, like when I'm talking about money, they are talking about $1 million. All right, they have a lot of $1 million to buy an asset in the market, and you retail trader, you don't have up to that amount. So maybe, for example, the bank want to buy Bitcoin for $100 million. All right, so a single retail trader like me and you does not have Bitcoin worth $100 million to exchange with them, because in buying there must be seller for there to be what? A buyer. All right, there must be seller. Somebody will be selling to you, so that you, that is the buyer, will be receiving the product and what? Paying with cash. All right, so there must be exchange. There must be seller for there to be what? A buyer. So the banks, they come with $100 million to buy Bitcoin. Who has Bitcoin worth $100 million to exchange for them, to sell to them? Who has it? Nobody. You see now, nobody has it. That is why there must be what? Manipulation in the market. You don't blame them. All right, so what they do is to manipulate the chart to look very beautiful, very sweet, that so many retail traders will say, oh my God, this is the best setup, bro. This is it. This is it. This is, I'm going all in. This is the best setup. And you see them stacking their stop losses. Now check, let's say 1 billion retail traders. 1 billion retail traders have a stop loss of just $1. How much is there? $1 billion. You see now, that amount is now equivalent to what the smart money wants to exchange their orders. And when they see that a lot of people has entered their stop loss because of that, I call that is inducement. Inducement is a trap. It's not a solid chart that will actually hold. It's just to entice or induce people to put their stop loss so that they will exchange it with their order. And once they have 1 billion people with 1 billion with $1 stop loss, $1 stop loss each, making it 1 billion stop loss, they will exchange the order. You see it they buy and then they get what they want. They exchange the order and they go. So you retail traders have to spot liquidity pools. That is very, very important, because if you don't know about liquidity, then they say you become what? The liquidity. You see, so liquidity and inducement is very, very important. In my explanation, I've already touched liquidity and inducement, but well, that's good. We are getting there. So I'm just trying to explain what supply and demand zone. These are levels where you look to buy an asset, and level where you look to what? Sell an asset. All right. You buy when it's cheap, you sell when the price is what? High. That is that about what? Demand and supply. So order block and fair value gap. I told you that when we have a demand level, before this market go up to break this structure, there was a gap that was left. That gap shows this displacement, shows that smart money were involved in the push that broke this structure. I don't know if you understand. Smart money is involved, and that push that broke structure, leaving a fair value gap, is like a trademark that tells you that yes, this push is very what? Strong. So smart money is important. So you want to see what that gap is, what we call what? Fair value gap. And then order block is just the last candle, the last red candle before that fair value gap and before that move that was broke what? Structure. Do not worry, in our live chat I will show you, I will pinpoint order block for you so that you will understand. All right, so automatically our demand zone, this is our demand zone. Order block is sitting right in our demand zone. All right, order block is sitting right in our demand zone. So our demand zone is just a combination of the order block OB plus what? The swing low. That is what our demand zone, that is the formula for demand zone. Our swing low is just this low. All right, so order blocks around here, so the combination of the order block plus the swing low is what? The demand zone. The same thing applicable to what? Supply zone. Supply zone is just opposite of this. This is a bullish market, and in supply zone we'll have something like this, market breaking to the downside like this. So this is what? Supply zone. We expect market to come to this area so that we'll sell what? The asset. Okay, we sell to the asset. Selling has to do with what? Price going down. Buying has to do with price rising up. All right, so that is that about what? Order block and what? Fair value gap. Then liquidity and inducement. I just told you liquidity is simply money, and then inducement is the trap. It's a trap that makes people want to enter a trade or take an order when it is not yet the right time. That beautiful setup, that trap that makes you look like price is going without me. You know, that thing that pushes you to place your trade when it's not yet the right time is what? Inducement. It is a trap, and inducement always go with what? Liquidity, because once you enter the market there are a lot of money involved. All right, so that sweep is what we call liquidity sweep. All right, it creates liquidity. Liquidity is simply what? Money, a lot of money, $1 million, and then that sweep of liquidity is what we call what? Liquidity sweep. All right, that is another topic for another day. All right, I will explain it, but just know that liquidity is money and inducement is what? Trap. So that is that about what? Liquidity and inducement. I'm just trying to rush up so I don't waste your time. All right, any question, please do wait to write it in the comment section. It is very important. I will always look at it, I will respond to you guys, and I will make sure I follow you guys step by step until you understand how trading works. This alone can make you financially stable. All right, when you understand this very well, it can make you financially stable. You see the secret of how the banks trade, how they make money with your savings account. All right, a lot of money, people that have savings account, the banks trade them. All right, some of them trade gold, some trade real estate, some trade oil, crude oil, that is US oil, some trade stock markets, some trade Bitcoin, a lot of things. As long as it has to do with charts, technical and fundamental analysis, that is where we are committed. This is it here. All right, so that is that about liquidity, about inducement. So we have time frame analysis. The daily time frame is very important. The daily time frame, daily, is very important. What we do on the daily is to understand the direction of the market, to get our bias, whether we are bullish or we are bearish. We want to see this kind of movement. If we are bullish on the daily time frame, then your bias becomes what? Bullish. The next time frame you go down to is what? The 4-hour time frame. The 4-hour time frame is to look for what? Demand zones. Knowing that you are bullish, you're looking for demand zone to buy. Don't go and be looking for what? Sell. Sell will be a kind of counter trading. All right, so if you're not well experienced, do not counter trade. It's not like it's not good, but it is more riskier. All right, it is more risky to what? Counter trade. But for now, you have to follow what? The market direction. The market trend is the higher time frame trend is your friend. All right, the trend is your friend, so follow the market direction. For example, in this illustration, the daily time frame is bullish. All right, so the 4-hour time frame, you go there and you look for what? Demand zones where you want to buy from, and you wait. You mark it out like this and you wait until price come there. You have no business with the market. Once you mark it down, you close your laptop, you go and sleep. You set alerts. Any day price comes there, that is when you want to be interested in the market. And when you're interested in the market, once you go there, once price hits the 4-hour zone, the next time frame you want to look at what is the 15 minutes time frame for confirmation. All right, this is for confirmation. The daily time frame is for buyers. The 4 hours to look for demand zones, and 15 minutes is for confirmation to confirm if that zone is actually gonna hold. All right, and in confirmation, we want to see what a change of character, liquidity sweep, fair value gap, inducement, and then before you take your trade. I will explain these things when we get to the rate chart so you understand very well. But because for the sake of illustration, I think I explained it one time about liquidity sweep. Now look at this. Let's say market was coming down at a point, it changed character. This is what change of character to the upside. This last low becomes what your liquidity sweep, and then we expect price to come down to around this demand area so that we'll buy. Before we place demand area, we want to see that there is a gap, a huge gap, which market will have to fill. And sometimes market will come close to that gap, retrace up. This becomes what inducement. You see it coming back to sweep people's stop losses here. Tap our order and then give us. This is, I will take my time to explain this entry. This is what a lot of people find it very difficult in trading industry. They find it difficult for confirmation. This pattern is what we know that what is known as SMC, smart money concept. All right, when it comes to entry, it is very detailed. You have to see. All right, you have to see. But mind you, there is no best setup in this industry, and that is why risk management is very, very important. That will be our next class. So that is that about what confirmation in 15 minutes. Then lastly, we have fundamental, technical, sentimental analysis. Now fundamental is just, trying to look at news. All right, you look at news, what is happening in the market. What is happening to dollar? Is dollar really bullish? All right, because sometimes news affects the movement of what the chart. All right, because of maybe the US secretary, maybe I've forgotten. I don't really trade fundamental because it can also some persons say it is not easily manipulated, but I bet you guys it can be manipulated by these big boys. All right, if they really want to manipulate the market, what they need to do is just to give false information. All right, there are news that give wrong information. Just they say sometimes you buy the rumor, or what? How do they call it? There is one saying, I've really forgotten. But that's those that deal on fundamental. I don't even look at fundamental because I have no news. I will not be looking at news. I don't look at that. I trade technical, pure technical with my risk management. There is nothing that is concerning me with fundamental. Right? Sometimes the fundamental can help my trade go well. Sometimes fundamental can help my trade go bad. But it doesn't matter. I journal my trade every day. I take trade, and I know what I see before I take my trade. So I repeat that pattern every day, whether there is news or there is no news. Or like some person trade fundamental. So fundamental is just what simply looking at news. And when it comes to sport, and it's also attached to sports trading. It is more of sports trading, because in sport trading you just want to buy assets and sell. But the asset you want to buy, who is the owner? When did they create the asset? Who are those in charge? Who are the head of department or board of trustee or what? These things you ask, you want to know these people, and if you actually know these people, you look at the social media, you know that they are real, they are legit. That gives you more trust to buy the asset and hold. Now that thing that's research is called fundamental analysis also. All right. So technical analysis is just within the chart. You look at the chart. It is very technical. That is looking at the chart. All these things, market structure and the rest of them. That's what technical analysis is very huge. In fact, all these things we are talking about, from this market structure to this part, they are with technical analysis. There's nothing like fundamental there. Fundamental the fundamental is a very different thing altogether. Going to make research, social media, looking at news, what is happening in the market, how does this news affect the market, how does sometimes war affect the market. Is there war going on? People are afraid and people are removing their funds from dollar, putting it here, and you see market falling. All of those stuff has to do with what fundamental. All right, so but I'm teaching you technical. That's what I do most of the time. This fundamental can be applicable to sports trading, but technical has to do with what more future trading. So sentimental analysis is just simply at a point. It is mostly when you want to take your entry. You know, some persons, they can see, for example, I want to take trade here and I want to place my stop loss here. They can measure the distance of their stop loss to where they want to take trade from, and other block they will say, it's too big, oh, it's too big, I don't want, it's too big, let me just divide it by 2, or let me just bring it down a little. That act of self decision is what sentimental analysis. You that say, let me just bring it down, let me just buy at 3 naira instead of 1 naira, because sometimes market may not get to 1 naira, you see it rally up, let me just buy at 3 naira. Another person is thinking, okay, let me just buy at 1 naira. Another person is saying, let me buy at 2 naira. Those decisions, different decisions by different people, is sentimental analysis. Alright, so it's totally different thing, but just know that you want to buy anywhere around what your demand level. Okay, anywhere around the demand zone you want to buy. So it's left for you to choose. But me, there are things I see specifically that tells me that, bro, buy at this point, and that is where I'm buying. So in our technical analysis in the chart, I will teach you, I will show you all those things so you understand very well and understand how the market goes. So that is that about what fundamental, technical, and sentimental. So any question, guys? Yeah, any question? Yeah, you that is looking at me now. Yeah, any question? Put it down in the comment section so that I can see it. All right, I will respond to you one after the other, and by the time we finish through with these lessons, I will be able to at least get like 2 or 3 people that knows what they are doing in the trading industry. All right, they knows what they are doing in the trading industry. Not everybody is profitable, but if you have a strategy that has an edge and you stick to it consistently with risk management, bro, you see yourself improving in the industry. This trading of a thing is skill, it's technical skill. It's not just taking decision out of emotional choice. No. There are things you need to see before you say, okay, I want to buy. All right, it is study, it is analysis, it is skill. It's not something that anyone can just, except if you're just going there to say, okay, you know, let me just buy from here. No. You're gambling. All right, because you're taking decision just out of your emotions. There's no structure behind it. All right, so it becomes what gambling. But when there's a structure, when you know what you're doing, you want to see this particular setup every day to buy. Don't miss one thing. If it is 4 things you want to see that 4 things complete. When you see that 4 things complete, you buy. Any day you see that 4 things complete, you buy. Any day you don't see one, leave the trade. That 4 things must be there before you buy. Then journal your trade. See out of 100 trades, see how many you make profit with. Then check your risk reward. Risk is to reward. Then check how much your capital savings, how you analyze your risk management. You see that you're really making profit, and the banks will look for you, say, bro, come and trade gold for us. This is your percentage, this is your this is this. That is how some persons make it in the industry. So, but for now, don't even think people to look for you. When you're good in what you do, in fact, they will see that this particular person taking trade here is so good, let us look for this guy. When you're very good with what you're doing, you just receive an email, piam, from US department, say, bro, please, we'd like to invite you over, we need to talk with you. Come and tell us what you do to make this kind of win rate, and we are willing to offer you $10 million. This will be your percent, this will be your percent, this will be, and you see your life change from there. So it's not by talking too much. So guys, I know I've delayed, but so sorry for that. So any question, please put it down in the comment section. I will respond to you. So thank you guys for following me to this point. I love you so much. Please do well to subscribe to this channel, like, comment, share. All right, so other people that are struggling in the trading industry can be able to have an edge and see something that will help them build their trading career. Thank you very much. I love you guys.